First of all, on behalf of the Reserve Bank, a warm welcome to you all. A short while ago, we put out the first quarter review of monetary policy for this year. Based on an assessment of the present and prospective macroeconomic situation, we've decided to keep the policy repo rate under the Liquidity Adjustment Facility, LAF, as also the cash reserve ratio, CRR, unchanged. Accordingly, the repo rate stays at 7.25%, the reverse repo at 6.25%, and the CRR at 4% of the net demand and time liabilities, NDTL, of scheduled banks. The marginal standing facility, MSF rate, used to have a markup of 100 basis points above the repo rate. You will recall that earlier this month, we increased that markup to 300 basis points, raising the MSF rate to 10.25%. As there is no change in the repo rate, the MSF rate stays at 10.25%. The policy stance in this review was informed by two considerations. The first consideration was the need for continuous vigil and preparedness to proactively respond to risks to the economy from external developments, especially those stemming from global financial markets. The second consideration behind the policy stance was managing the trade-off posed by increased downside risks to growth and continuing risks to inflation and inflation expectations. Let me now indicate the forward guidance that we've given. The monetary policy stance over the last 2 years has predominantly been shaped by the growth inflation dynamic, even as external sector conditions have had a growing influence on policy calibration over the last 1 year. The current situation, moderating wholesale price inflation, prospects of softening of food inflation consequent on a robust monsoon, and decelerating growth would have provided a reasonable case for continuing on the easing stance. However, India is currently caught in a classic impossible trinity trilemma. We're having to forfeit some monetary policy discretion to address external sector concerns. The liquidity tightening measures instituted by the Reserve Bank over the last 2 weeks are aimed at checking undue volatility in the foreign exchange market. They will be rolled back in a calibrated manner as stability is restored to the foreign exchange market, enabling monetary policy to revert to supporting growth with continuing vigil on inflation. We've emphasized that the time available now should be used with alacrity to institute structural measures to bring the current account deficit down to sustainable levels. As always, our policy decision has been based on a detailed and careful assessment of the global and domestic macroeconomic situation. Let me begin with our assessment of the global outlook. Global growth has been uneven and slower than initially expected. The tail risks to global recovery had eased in the early part of the year, but that improvement was overtaken by the flash turmoil in the financial markets because of the announcement effect of the tapering of quantitative easing, QE, by the US Fed. In advanced economies, activity has weakened. Emerging and developing economies are slowing and are also experiencing sell-offs in their financial markets, largely due to the safe haven flight of capital. The dollar has appreciated rapidly on the back of market expectations of QE taper and the resultant increase in real interest rates. Consequently, currencies of emerging and developing economies have depreciated. Commodity prices have generally softened, but the price of crude remains elevated. Here at home, economic activity weakened in the first quarter of this year. Industrial production remained muted at 0.1% during April-May. In May, there was an absolute decline of 1.6%, spread across all constituent subsectors, barring electricity generation. Capital goods production continues to contract, reflecting deteriorating investment conditions. Fortunately, the monsoon arrived on time and rainfall to date has been above the long period average. Consequently, Kharif sowing has been significantly higher than a year ago. In the May policy, the Reserve Bank projected GDP growth for the current year of 5.7%, conditional upon a normal monsoon, returning agricultural growth to its trend level. The outlook for industrial activity, however, was expected to remain subdued. Also, growth in services and exports was expected to stay sluggish, owing to global growth not improving significantly. While the onset of the monsoon and its spread have been robust, the persisting weakness in industrial activity has heightened the risks to growth. Moreover, global growth has been tepid, with consequent adverse spillovers on India's exports, manufacturing, and services. On the basis of the above considerations, the growth projection for the current year is revised downwards from 5.7% to 5.5%. Let me now turn to inflation. Headline inflation, as measured by the Wholesale Price Index, edged up slightly to 4.9% in June after declining for 5 months on a clip. The pickup was mainly driven by a spurt in food inflation, especially in respect of vegetables and cereals. Fuel inflation declined due to the reduction in coal prices in March and easing of inflation in electricity prices because of base effects. Non-food manufactured products inflation fell to 2% in June, the lowest since December 2009. Retail inflation, as measured by the new series of Consumer Price Index, had moderated somewhat during April-May, but it surged close to double digits in June, driven by a sharp increase in food prices. In the May policy, the Reserve Bank indicated that during the current year, WPI inflation will be range-bound, around 5.5%, with some edging down in the first half and some edging up in the second half, mainly on base effects. The inflation trajectory in the first quarter of this year has moved largely in line with these expectations. Keeping in view the domestic demand-supply balance, the outlook for global commodity prices, and on the expectation that the spatial and temporal distribution of the monsoon during the rest of the season will be normal, the Reserve Bank will endeavor to condition the evolution of inflation to a level of 5% by March 2014. Now a brief comment on the liquidity conditions, which have eased considerably since the May policy. The average daily net liquidity injection under the Liquidity Adjustment Facility, LAF, declined to 828 billion rupees in the first quarter of this year, down from over ₹1 trillion during the last quarter of last year. Government balances have been in deficit since June 28 and have bolstered liquidity, thereby significantly reducing the demand for funds under the LAF. The net drawal from the LAF declined markedly during the first week of July. On July 26, the net drawal was 558 billion rupees, including a drawal of 229 billion rupees from the marginal standing facility. I've so far given you the Reserve Bank's assessment of the global and domestic macroeconomic situation and our projections for the current year. Let me now briefly indicate the risks to that macroeconomic outlook. First, the biggest risk to the macroeconomic outlook stems from the external sector. Financial markets around the world went into a flash turmoil beginning May on the perception of an earlier than expected tapering of its quantitative easing by the US Fed. The rupee depreciated in nominal terms by as much as 5.8% between May 22, the day of the first announcement effect, and July 26. This was a consequence of sudden stop and reversal of capital flows in reaction to the prospective change in the US monetary policy stance. It is not clear if financial markets have factored in the full impact of the prospective tapering of QE, or whether they will indeed react to every future announcement of tapering. We are dependent on external flows for our financing our current account deficit. India will therefore remain vulnerable to confidence and sentiment in the global financial markets. The second risk factor is a large current account deficit. The CAD has been well above the sustainable level of 2.5% of GDP for 3 years in a row. This is a daunting structural risk factor. It's brought the external payment situation under increased stress, reflecting rising external indebtedness and the attendant burden of servicing external liabilities. Most external vulnerability indicators have deteriorated, indicating that the economy's resilience to shocks is eroded. Furthermore, the growing vulnerability in the external sector reinforces the importance of credible fiscal consolidation with accent on both the quantum and quality of fiscal adjustment. The third risk factor to our macroeconomic outlook is that the investment climate remains weak, and risk aversion continues to stall investment plans. The outlook for investment is inhibited by cost and time overruns, high leverage, deteriorating cash flows, erosion of asset quality, and muted credit confidence. Finally, an environment of low and stable inflation and well-anchored inflation expectations is necessary to sustain growth in the medium term. To engender this benign growth inflation environment, it is critical to ease the supply constraints in the economy, particularly in the food and infrastructure sectors. Without policy efforts to address the deterioration in productivity and competitiveness, the pressure from wage increases and upward revisions in administered prices could weaken growth even further and exacerbate inflation pressures. Let me conclude by summarizing our macroeconomic concerns. Risks to growth have increased, notwithstanding the robust onset and spread of the monsoon. Industrial production has slumped, with lead indications of declining order books and input pressures building on rupee depreciation. Meanwhile, depressed global conditions are undermining export performance, even as heightened volatility in capital flows has raised external funding risks. Wholesale price inflation pressures are on the ebb, but retail inflation remains high. Monetary policy going forward will be shaped by considerations of supporting growth, anchoring inflation expectations, and maintaining external sector stability. The foreign exchange market came under severe stress starting May, prompting the Reserve Bank to institute liquidity tightening measures to contain the volatility. The recent measures by the Reserve Bank to restore stability to the foreign exchange market should be used as a window of opportunity to put in place policies to bring the CAD down to sustainable levels. Over the last 1 year, the government has taken several policy initiatives to improve the investment environment. As these initiatives work through the system and are further built upon, the current slowdown can be reversed, returning the economy to a higher growth trajectory. The Reserve Bank will have to ensure that the economy traverses that high growth trajectory in an environment of price stability and financial stability. Thank you very much for your attention. Thank you.